Hey guys, it's Stan here. Let's start with a question. What do Airbnb, Spotify and Slack have in common? Well, first of all, they are all three tech firms, but this is not what makes them so special for this video. What makes them so special for this video is that all these three companies have decided to go public, but not using an IPO, which is a conventional way of going public, but to do it with an alternative way of going public. So in this video you will learn two alternative ways for tech firms to go public. So before we talk about the new alternatives to go public, I wanted to give you a little bit of background what going public means really and what has changed over the last, let's say, 20 years. So two examples here. Amazon was founded in 1994 and went public, so they did an IPO, initial public offering, in 97. Compare this to Uber. They have been founded in 2009 and they did their initial public offering in 2019. So you see that within 15 years there has been a huge shift, because as you can see here for the Amazon example, between when the company was founded and the IPO there were only 3 years, and for Uber it's been 10 years. So that's the first very big shift you have to understand, because it's going to explain the alternative ways. So why did it become, why are companies waiting much longer now before they go public? Basically there are two reasons. First of all, when you look back at the 90s and the beginning of 2000s, it was pretty complicated for a company like Amazon to grow fast without going public, because obviously to grow fast, to expand globally, you need a lot of money. And back at this time, it was very difficult to raise capital outside of the capital markets. So it was very difficult to do it when you are still private. That's why actually, to grow very fast from the beginning, Amazon decided only after 3 years to go public. As you can see, this has changed with Uber, because Uber stayed very long private before they did the IPO and became a public company. As I mentioned, there are two reasons. First of all, the capital markets and the entire finance world has changed, and the companies itself have changed. First of all, when you look at the capital markets today and the finance in general, today it's much easier to stay private for a long time, because you have venture capitalists and private equity. They have developed very much in the last 20 years. They have a lot of money to pour into this private market. That's why they have allowed, for example, Uber to grow so long. And obviously, if you know the story of Uber, it was pretty expensive to grow over 10 years. They burned a lot of cash, but it was possible because they have very deep-pocketed venture capitalist investors. So they were not in a rush to go public. That's the first reason. And second of all, companies have shifted. When you look back 20 years ago, companies were, when you look, for example, 2007, the biggest companies were oil companies, so very industrial, asset-heavy companies. When you look today, 2020, for example, you will see that the biggest 5 companies in the world, and in the S&P 500, for example, in the US, are tech companies, so asset-light companies. What I want to say here is actually, when you're moving from an asset-heavy company to an asset-light environment, you need less money to operate. You know, Uber is running an app. They need less money than, for example, ExxonMobil, who is running a lot of oil companies all around the world. So if we want to put it into perspective with some time frames, it would be like 1990 to 2010. It was very difficult to raise capital for a private company before going public, and companies were usually asset-heavy companies like big oil companies. Then in 2010 the shift really started, and now it's just going crazy. It's super easy to raise capital for private companies, especially since venture capitalists had more and more cash to invest, and companies are also becoming asset lighter companies, as you can see with all the tech companies popping up all over the globe. Okay, now you might ask yourself, but why go public? I mean, a company has easy access to capital. staying private, so why go public? Actually, here again there is a big shift. Before 2010, it was clearly, and I showed it with the Amazon example, it was to raise capital to grow. That was kind of the ultimate goal of going public. That's why companies did IPOs, initial public offerings, because when you do an IPO, initial public offering, you can raise capital, and that was the ultimate goal before 2010, let's say. After 2010, the strategy has shifted a little bit. As I mentioned before, now it's pretty easy for a company to grow privately, because behind them there is a big investor like a venture capitalist who is investing in your company and has deep pockets. But obviously this investor, he's not doing it for fun, he's doing it for returns. And the best way to get a great return is to have a good exit strategy for the founders of the company and for the early investors of the company. So now when you look at how companies went public, it was pretty easy. Before 2010 there was no questions actually. It was clearly we need to raise some capital to grow, and the only way to do it is with an IPO, initial public offering. So here there was absolutely no question and no debate. After 2010, and especially for tech companies which are asset light companies, where you don't need that much capital to be raised, the question started to pop up, but hold on, do we really need an IPO to go public, or is there something else we can do? The reason why I'm saying this is actually last week I made an entire video about IPO, linked here, where I'm explaining how an IPO works, when to do it, and the pros and cons. I listed here the cons, and that's the big reason for the new alternatives. For an IPO, actually, it's extremely expensive to do an IPO. To give you a brief indication, it costs between 4 and 7% of the listing price. Let's say your goal is to be listed for $1 billion at the capital market. 4 to 7%, that's between $40 and $70 million. So that's a crazy cost. Then the timing component, with all the paperwork, with the lawyers and all that stuff, it takes about a year. So that's super heavy duty when it comes to timing and paperwork. And then there is also a big con of IPOs, which is the conflict of interests. As I mentioned in this IPO video, you have 3 partners when it comes to IPO. You have the company, which wants to go public. You have an investment bank who works for the company. And this investment bank will do a roadshow, meaning they will say, hey, I have a new great company going public, do you want to buy shares? And they're going to do it to public investors. The problem here is you have a clear conflict of interest, because the bank, the investment bank, they're working for the company, but they will offer shares to public investors, and usually they will offer shares to public investors they already know, pretty big good clients. They don't want to lose them, they want them to have a good return, so they will probably when they do the roadshow, imagine they could sell shares for $100, for $100. Maybe they're gonna sell them for $90, so below price, so that these guys can make a quick profit. And actually that's why especially tech companies are not big fans of IPOs, and that's why they are looking for alternative ways. Now let's find out the 2 alternative ways how to go public without an IPO. Now let's talk about the first form, which is called direct listing. And here my 2 companies pop up that I talked about at the beginning, and why it makes sense. Actually, Spotify, Slack already did their direct listings, and Palantir, which is a data analytics company, are planning to do it until the end of 2020. So how does it work? A direct listing is also called, it's not called an IPO for initial public offering, but it's called a DPO, so direct public offering, and you will directly see the difference here. Basically, as I just mentioned before, in a normal IPO, it's not direct. You have a company, you have an investment bank, which is also called the underwriter in the middle, and then you have the public investor. So the problem for a company usually is you do not have the price control. You don't know for how much your shares are going to go. in this direct public offering, the big advantage is you have the company who wants to do the direct listing, you have an automatic auction, and you have public investors. So how does it work in practice? Imagine my company, let's say Spotify for example, they have a total of 100 shares that are right now privately owned, and they want to go public, meaning they want to sell their shares here. An automatic auction will take place here, very simplified, but you get the point. And imagine you have two bidders, one who wants 50 shares for $20 and the other one wants the other 50 shares for $19. So they're gonna get the shares, they're gonna get the 100 old shares for these prices, meaning here the old shares get new owners. That's the only thing that is happening. There are no new shares which are issued, so the old 100 shares are sold to public investors. So it's just a trade at an auctioned price. So that's super interesting for these kind of companies, because as you can see here, and when you look at the pros and cons, you have no underwriter. The underwriter for an initial public offering usually is an investment bank, and investment banks ask for 4 to 7% of the entire listing, so that can make up a huge cost. So here you're saving the intermediate guy, which costs you a fortune. Then, as I mentioned before, there is no conflict of interest here, because there is no investment bank who always has to satisfy their clients, so there are no discounts here to favorite clients. If your public investors want your shares, and if you have done the whole process in a good way, and if you are a strong company with a good balance sheet and good reputation, they're gonna pay the price, and you know what to expect. And also, I haven't mentioned it before, but there is also the fact that since no new shares are issued, there is no dilution here in the process. Dilution would be, let's say, 100 shares become 150 shares. So there's a bit of dilution. Here in this case, there is no dilution, because 100 private shares become 100 public shares. And in the cons, as you can imagine, well, there are two things. First of all, it's not possible in this model to raise new capital, and that's why it's interesting, and that's why I was mentioning tech companies, which are asset light companies, because usually, and that's why Spotify and Slack did it this way, they didn't need new fresh capital, because they were already growing and they had already enough cash on their balance sheet. So their goal was not to raise new capital. So that's a con here. You cannot raise new capital. And there is also no advisor on your side, because obviously when you have an investment bank, maybe there is a conflict of interest, but usually they help you to get to look good when it comes to the IPO. Here you do not have this expertise from the investment bank, so you have no advisor. So make sure you have the right people, the right consultants that can help you to make a direct public offering a success. So now that we have talked about the direct listing, let's talk about the second alternative way to go public. The second way to go public without using an IPO is what is called a SPAC. Pretty fancy name, Special Purpose Acquisition Company. Let's look at it. You will see it's more complicated than a direct listing, but it also makes sense. So you will see you have 4 different steps to arrive to a SPAC. So it all starts with setting up an empty shell company. Then this empty shell company will go public using the regular IPO. So they will do all the paperwork, all the costs and all the stuff here. So this IPO will be publicly traded at some point, this empty shell company. And the promise that is said during the IPO is to say, okay, we are now an empty shell company. We are expecting so much cash from you, investor, because our promise is to say we want to buy private companies. That's the goal here. Once the IPO is done, the shell company will use the cash they just raised from the IPO to buy a private company. And at the end, to fulfill this spec, a merger between both companies, so between the shell company and the privately owned company they just bought, will happen, which will make them one, obviously, because it's a merger. And in this case, the newly acquired private company will become public without doing an IPO alone. Actually, the IPO happened before. The shell company is a specialized company, and you will see that the SPACs are becoming more and more right now, because a lot of big hedge funds who are specialized in these kind of deals are going into the game. So right now we had 60 deals in 2020 between January and September, valued at around 22 billion already, so it's kind of a big deal. And the biggest company, I didn't know them, is also a tech company. They're called Nikola Motors, and they do like electric trucks and these kind of things. So that could be promising as well. You see that here it's a bit more complicated to understand, but the goal is the same, is to go public without this complicated IPO process. And here I listed the pros and cons again. For the pros, it's definitely faster than an IPO, because once the IPO here is done by the specialist company, so by the empty shell company, then here the company just has to acquire a new private company and they will merge together. So that's faster because they are specialized in that, and it's also cheaper because once the IPO is done, it's just gonna be a price negotiation to buy this private company. And that's also a very big pro. There's gonna be a direct price negotiation. That's what you want when you want to go public, between the buyer and the seller. There is no intermediate here, so here again you will find the same pro as for the direct listing as well. For the cons, roughly the same game as before. Here again you're not able to raise capital, so SPAC is interesting for companies who already have enough capital, so they don't need to raise new capital. And then another con here for this special purpose acquisition company is that entrepreneurs usually who just sold their companies, they don't want to be part of a new shell company. So that's to be seen if it's gonna work long term or not. Okay, so now I wanted to tell you, we have about 225 unicorns in the world right now, so companies that are privately owned with a valuation higher than $1 billion. And these companies at some point, they're gonna go public. Now I wanted to know from you, what do you think is the best way for them to go public? For example, Airbnb in the next couple of months probably. So what is the best alternative? Do you think the normal IPO is the best way? If you don't know exactly what an IPO is, here and in the link in the description below for my video from last week. Otherwise, do you think direct listing or SPAC make more sense to go public? So comment in the comment section below. And I also wanted to tell you that I post once a week every Sunday. Teaser for next week, I'm gonna explain you how you can convert raw data into a beautiful and meaningful reporting. That can be very helpful for you if you want to be an analyst or if you want to pitch an investor. So stay tuned, see you soon on the channel. Make sure to like this video if you like that kind of content. See you soon guys, bye bye!